Top down, the biggest potential source for fuss in the week ahead is the latest meeting of the oil cartel OPEC's members in Vienna on Thursday the 6th of December. 2 years ago, OPEC surprised a lot of people, including me, by agreeing to cut its output by 1.2 million barrels of oil a day to around 32.5 million, with Saudi Arabia leading the way. Non-OPEC members spearheaded by Russia joined in, as they trimmed production by some 0.6 million barrels a day, and those cuts were eventually extended out to March 2018. Coupled with a respectable, if not rip-roaring economic growth, and the threat of fresh American sanctions on Iran, those cuts were enough to help forge a recovery in the price of crude all the way up to nearly $80 a barrel using Brent as a benchmark. However, this autumn, oil's rattled back to barely $60 a barrel. America unexpectedly made some exemptions to its sanctions. US shale outputs continued to mushroom, reaching nearly 7 million barrels a day, and OPEC itself has started to gently increase production again. Led by renewed growth in Saudi Arabian output to some 10.6 million barrels a day in October, OPEC churned out 32.9 million barrels of oil a day that month. President Trump's pressing for further increases to production and for cheaper oil. So when it comes to assessing the news from Vienna on the 6th, the three things to look for in the communiqué are as follows. Comments on production relative to the 33.7 million barrels a day level that prevailed before the cuts of 2 years ago, the 32.5 million target set then, and the current rate of just under 33 million. Secondly, look for any comments on the timeline for any production targets. And finally, look for any pointers on the intentions of non-OPEC members, particularly Russia, which again did reduce its output by around 300,000 barrels a day a couple of years ago. On the home front, there's a smattering of trading statements and corporate results due from FTSE 100 and FTSE 250 firms, and they should make for informative reading. The companies involved include McCall's Retail on Monday the 3rd of December, not least because they have a wholesale deal with Grocer Morrison's, Plumbers Merchant Ferguson, Woolsey as was, van rental expert Northgate and specialty chemicals company Victrex on the 4th, when we're also due to get the results of the latest quarterly reshuffle of the leading FTSE indices. The memberships of the FTSE 100 and the FTSE All-Share benchmarks can change on those days. On Wednesday the 5th, we got retailer Jewel set to publish a trading update, and shareholders in drug firm Shire will get to vote on whether to accept a takeover bid from Japan's Takeda or not. And on Thursday the 6th, we get results from FTSE 100 packaging giant DS Smith and a trading statement from retailer Ted Baker. We also close out the week on Friday the 7th of December with what I suspect could be the real source of fuss in the week ahead on the corporate front, namely first half results from FTSE 100 member and high-end house builder Berkeley Group. As we can see here, worries about the UK economy, consumer confidence and Brexit mean that Berkeley shares have done poorly so far in 2018, so this at least makes the interim report particularly timely. The items to watch from the first half numbers will be as follows. First, the trend in reservations and whether there has been any stabilisation here. This will also be reflected in the forward order book, which came to £2.2 billion at the end of Berkeley's last fiscal year. Second, look at the trend in pricing. In its last full financial year, Berkeley's average selling price was a meaty £715,000. This next graphic shows how Berkeley's average annual selling price has developed since the Great Financial Crisis ended. Third, look at earnings. Berkeley's guidance for profits leaves the consensus for pre-tax income at £640 million, down substantially from last year's £935 million. Fourth, look at cash returns. By the end of this half in September, Berkeley will have returned £10.34 a share to investors as part of its total plan to return £16.34 by 2021. Watch out for the comments on mix between dividends and buybacks. And fifthly and finally, look at net asset value or NAV per share. Now that came to £19.59 at the full year stage. This last chart shows how the NAV has developed on an annual basis, also since the Great Financial Crisis. Now Berkeley shares do still trade at a big premium to that NAV, despite the questions over current trading. That's partly down to the fat backlog and good visibility, but also the company's cash return plan with another £6 a share due to shareholders over the next 3 years in equal instalments, though again, the mix between dividends and buybacks could change. Thank you for watching, and I look forward to seeing you next time.